Hi there. Today we're covering the product individual investors buy more than almost anything else, whether they hold US stocks, international stocks, or both. ETF means exchange traded fund, a basket of many companies packaged into one share you can trade like a stock. In plain English, instead of buying 500 stocks one by one, or piecing together Japan, Europe, and emerging markets yourself, you can own a whole slice of the market in a single ticker. But there are three traps. First, a juicy dividend yield that hides cut risk. Second, 2x and 3x leveraged products and their compounding losses. Third, themes that pile into one industry and concentrate risk. By the end of this lesson, you'll know which ETFs can sit in a long-term portfolio, including international and country funds, and which ones you should almost never hold for years. The chart in front of you is SPY, an ETF that holds the S&P 500, roughly the 500 largest U.S. companies. Buying this one fund is a lot like owning that whole board at once. The key word is cost.
Crude index ETFs like SPY often charge about 0.03% a year.
On a $10,000 position, that's only about $3 a year in fees. What if you tried to rebuild that yourself? You'd pay commissions and spreads on hundreds of trades at your broker, wrestle with tax lots, and burn evenings just keeping the weights in line, and that still wouldn't give you international exposure. That's why a simple core of low-cost index ETFs, U.S. Broad Market Plus an international fund like a Total World ex-US or Developed Markets ETF, is usually the smartest way for beginners to start a portfolio. Simple, cheap, powerful.
Historically, the S&P 500 has returned roughly 10% a year on average since 1950.
Check that long-term trend on the chart yourself. And remember, past returns are not a promise for the future. Economies move in cycles, a bit like seasons: spring, recovery; summer, expansion; autumn, peak; winter, slowdown, and the pattern keeps repeating. Which industries lead changes with each phase? In recovery, financials often wake up first. In a boom, tech can dominate. In a slowdown, consumer staples tend to hold up better. XLF on your screen is the financial sector ETF, banks, insurers, and related names. When the Fed is hiking rates into a strong economy or credit is expanding, this group often leads. When you invest, compare relative strength across sectors and across countries. Overlay the broad market, SPY, with tech, QQQ, and you'll see whether we're in a tech-led cycle or a finance and staples cycle. Japan, Europe, and emerging markets have different sector weights, so the same cycle can look different abroad. On the chart, compare how each sector has moved. Spotting which sleeve is leading right now is often more useful than guessing the next Fed headline. NVIDIA on screen is a flagship AI chip name. Themed ETFs package stocks like this, one industry, one story, into a single fund, including country or niche themes. During the 2023 to 2024 AI boom, some of those theme funds looked unstoppable.
플랜티 로즈 100% 오르모어.
Hard not to feel FOMO, right? Here's the trap. Over that same stretch, the S&P 500 as a whole was up about 50%, while AI themes also suffered sharp drawdowns along the way. Volatility was roughly triple the broad market.
Why?
When a theme goes out of fashion, money exits that industry almost overnight. The mid-2024 AI pullback made that painfully clear, and the same pattern hits country or next big thing when the narrative flips.
Bottom line, 테마 ETFs are risky.
If you use them at all, keep them to about 10% or less of the portfolio. They do not belong as a long-term strategic core. High dividend ETFs like SCHD can show yields around 4%, which looks better than a plain savings account paying roughly 0.5% and is competitive with many online high-yield accounts in the mid-2020s. On $10,000, 4% is about $400 a year, or roughly $33 a month. But the most dangerous trap hides under that yield number, the dividend coverage ratio. Coverage asks, how many times does the company's actual cash earnings cover the dividend it pays? If a firm earns 100 and pays 50, coverage is 2.0x. As a rough industry rule of thumb, 1.5x or higher usually means lower cut risk, not zero risk. In 2022, some high-yield products and holdings slashed payouts hard, in places by about half. Investors who chased yield got the cut and watched prices drop around 20% too. So never buy on the yield percentage alone. Always ask, can these companies keep paying this dividend through a Fed hiking cycle or a recession, and apply the same test to international dividend tests. A 2x leveraged ETF promises roughly twice the daily move of its index. A 3x product like UPRO aims for 3 times. Inverse funds like SPXU try to rise when the index falls, again on a daily target. On the surface, they're irresistible. Plenty of beginners buy 3x inverse, just in case the US crashes. Here's the trap: daily compounding decay. The reset is daily, so the path of returns matters more than the headline multiple.
웍트 이그젬플, 더 인덱스 라이지즈 10%, 된 폴스 9%.
The index is almost flat, about plus 0.1%.
but 3x UPR로 연트 플러스 30% 된 마이너스 27%, 유치 리브즈 유 다운 어바웃 5%.
Even in a sideways market, those daily resets can stack into a minus 20% hole within 6 months. Never treat leveraged or inverse S as long-term holds, short-term trading tools only, if you use them at all. Before you buy any ETF, US, international, or country, run this 4-point check. 1. Is the expense ratio at or under about 0.1%? SPY near 0.03% is among the cheapest. 2. If it pays a dividend, is coverage roughly 1.5x or better? 3. Is it overloaded on one industry or one story? Skip themes or keep them tiny. 4. Leveraged and inverse, short-term use only? Starting out, build a habit of buying broad index S on a schedule, something like SPY or a total U.S. market fund plus an international fund, developed and or emerging. Over long history, that simple core has been hard to beat. As you gain experience, you can rotate sleeves the way we covered, financials toward tech, or overweight a country when its cycle leads, without abandoning the low-cost core. Please remember, this lesson is for education only and is never a recommendation to buy or sell. Investment losses are entirely your responsibility.
ETFs are still market products. A 50% drawdown is absolutely possible.
Size positions to your own capital and risk tolerance. Next time we'll cover how to allocate across global assets. Subscribe and hit like if this helped. Thanks for watching.